following market update content was created by Ivan Gruhl, Chartered Financial Analyst and Chief Investment Officer at Avantax.
Hello, I'm Sandeep Varma, President and CEO of ATS Wealth Management. Today we will provide a market update for May. We'll start with a recap of returns through April and then shift to the discussion on earnings, the economy, and the Federal Reserve, ending with a note on the benefits of diversification. Starting with good news, all major stocks and bonds were positive for the first 4 months of 2023. The month of April saw a wide dispersion in performance across markets. Here in the U.S., the S&P 500 index was up 1.6%, while small-cap stocks failed to keep pace, lower by 1.8%. On the international front, developed markets saw a strong month of performance, with the MSCI EAFE gained nearly 3% in total return. Emerging markets struggled to keep pace, losing about 1.3% over the course of the month. This wide dispersion in performance has been a consistent theme throughout the first 4 months of 2023, highlighting the importance of diversification. For the year, international developed markets have seen the strongest performance, higher by nearly 12% as U.S. investors in foreign markets have benefited from a weaker dollar. Meanwhile, small-cap stocks have struggled on a relative basis, higher by less than 1% as trouble in the regional banking sector continues to weigh on small caps. In bonds, both taxable and municipal indices are higher for the year, with the Bloomberg Aggregate Taxable Index up 3.6% and Bloomberg Muni Index up 2.5% through April. Declining interest rates have fueled positive price performance for bonds. Turning to earnings, corporate earnings seasons are well underway for the better part of April, and so far, first quarter profits have held up better than anticipated. As of month end, nearly 2/3 of U.S. companies have reported results. Of those companies, about 70% have beaten earnings expectations, while 65% have beaten revenue expectations. Contrary to the Street's forecast of the earnings decline, operating earnings are on pace to show low single-digit growth for the quarter, bolstered by higher profits margin. The health of earnings and forward guidance by companies are important metrics that market participants will continue to monitor that will factor in whether the economy can avoid a recession. Even though corporate earnings are proving resilient, restrictive policy paired with financial stress from the regional bank turmoil has increased the risk of recession later this year. At the end of April, investors got a look at the advanced estimate of GDP for the first quarter of 2023. The report shows that real GDP rose by 1.1% on an annualized basis, markedly lower than the market's expectations for a 2% increase. In addition, the Federal Reserve's most recent summary of the economic projection shows that the central bank expects a real GDP growth for the year to come in around 0.4%. To reach this forecast, the economy would likely need to shift from expansion to contraction by the end of this year. Separately, the Federal Reserve is forecasting an unemployment rate of 4.5% by year-end, a full percentage point higher than where we stand today. Overall, banking system turmoil, largely caused by a rapid rise in interest rates, has added stress to the economy, and we are likely to see a very weak real GDP growth with a good chance of slipping into a recession by the end of this year. Despite signs of slowing economy, the Federal Reserve remains committed to stomping out inflation. In the past year, the Federal Reserve has delivered a total of 5% in rate hikes in an attempt to reduce inflation. Despite concerns around the banking system, the Fed hiked rates by an additional 0.25% at its May meeting. At the same time, the Fed provided signaling that the end of its tightening cycle is near. The Fed believes below-trend growth and an increase in unemployment will be necessary to combat inflation, and a soft landing is now less likely. The potential good news for our market is that our belief is that the rate hikes are now priced in, and investors should be able to look forward to more stability in interest rates, with overall rates now providing a much better income and return opportunities for bond investors. Finally, volatility has continued to challenge investors in the first 4 months of the year, with investors grappling with inflation and financial sector concerns, among others. Looking ahead, markets may face further challenges as markets contend with above-average inflation, lower profit margin for companies, and slowing growth. This final chart shows asset class returns, and we point out the white asset allocation box that is linked by the lines. An asset allocation of a broad mix of global stocks and bonds demonstrates the benefits that diversification offers over a long horizon. While picking the best and the worst performing asset classes each year is extremely challenging. This chart shows that a diversified portfolio has delivered investors a less volatile ride with solid returns over the long term. So that's what we have for this month. I want to thank you all for the trust and confidence that you have placed with us. And I want to say a special happy Mother's Day to everybody. Thank you. See you next month.